Today, I'm going to open up the topic of seller paid concessions, or often referred to as seller paid closing costs or seller contributions, whatever you want to call it. That's what we're going to talk about today. This topic can be very complicated and hard to understand for people who don't really speak this language. So, I actually wrote a full article breaking down what closing costs are, how to use seller paid contributions or seller paid closing costs, and a couple of different strategies. And this video is sort of simplifying that article, but I will put that article in the description of this video so you can read a more detailed explanation of all of these principles that we'll talk about today. So, what is a seller paid concession or a seller paid closing cost? As simply as I could put it, this is just a financial contribution that the seller makes to offset the cost at closing for the buyer. Now, a key distinction is that this is not a price reduction. The actual price stays the same. However, the seller will use money from their proceeds at closing to offset some of the closing costs or discount points for the buyer to make the buyer more able to purchase their house. Something that I've experienced in my career is, especially with first-time home buyers, it's very common that the buyer will have saved up enough money for their down payment or their closing costs, but it's very common that they don't have enough for both. So they need to essentially roll their closing costs into their mortgage. And the way that they do that is by asking the seller to give them a credit out of the amount of money that they're giving them at closing to go towards some of their closing costs or buy down their mortgage rate. So here's a mock-up of just a normal real estate deal. This is a $400,000 purchase price with a 20% down payment on a conventional mortgage. And let's say that there is $12,000 in closing costs associated with this deal. So let's go ahead and break it down. In the first scenario, we're going to ask the seller to reduce the sales price by $12,000, making the purchase price $388,000. With a 20% down payment, this means that we are going to be taking a mortgage of $310,400. That 20% down payment is going to be $77,600. And then, of course, we have our closing costs. Those are $12,000. So now in this scenario, the buyer at closing is going to have to bring $89,600 to closing. Now, with this exact same deal, this time we're not asking for the $12,000 off the sales price. We're asking for the seller to contribute $12,000 towards our closing costs. This means the exact same net proceeds to the seller. So because we're not negotiating a discount, the sales price is going to be $400,000. That same down payment is going to have us mortgaging $320,000. Our down payment, the 20%, is going to be $80,000. However, in this scenario, our closing costs are going to be zero. That means that in this deal, the buyer will have to bring $80,000 to the closing table rather than $89,600. Pretty simple math. This means that the buyer is going to have to come up with almost $10,000 less money to close this deal. So that's just one way that you can benefit from using seller paid closing costs, and probably the most simple way. However, when it comes to seller paid concessions or seller paid credits, you can't just ask them for as much credits as you want or roll into your mortgage as much credits as you want. Almost every loan product has caps or certain guidelines, regulations regarding how much you can ask the seller to contribute. If you're getting a conventional mortgage with less than 10% down, you can only ask for up to 3% of the total final negotiated gross sales price. However, with a conventional mortgage, if you're bringing anywhere between 10% down and 25% down, you can ask for up to 6% in seller paid contributions. And with that same conventional mortgage, if you're bringing more than 25% as a down payment, you can ask for up to 9% in seller paid contributions. Now, when you get into the government mortgages, the FHAs, the VAs, the USDAs, it changes again. With an FHA, you're going to have a 3.5% down payment straight across the board, and you can ask for up to 6% of the final negotiated gross sales price in seller paid contributions. The VA is a lot more complicated because it sort of has a two-bucket system, and I go over this in a lot more detail in the article if you're interested. With the USDA, USDA loan or a rural development loan, you can ask for up to 6% in seller paid contributions towards your deal. Now, if you're talking about jumbo loans or what we call bank statement loans, these are really going to vary from one lender to another. Now, the big risk in most real estate transactions is that the house actually has to appraise for the gross sales price and not the amount that the seller will actually be receiving. So let's mock up another deal. Let's say that we have a $405,000 purchase price and the buyer's getting an FHA mortgage. Let's say that they ask for the seller to contribute $21,000 towards their closing costs or discount points. The seller agrees, the appraisal's ordered, the appraiser goes out to the house, sends the appraisal to the lender, and it comes in light. They appraise the house at $395,000. Well, FHA goes out, recalculates, makes sure that the $21,000 still fits within the 6% of the gross sales price, which it does, but now the buyer has to bring $10,000 more to the table because we had an appraisal shortfall. So now we have a compounding problem where the appraisal creates a massive cash gap and puts the deal at risk. Now, this is one of my favorite strategies as it relates to how buyers or even sellers can use seller paid credits to actually leverage their advantage. We're talking about rate buydowns. First, we'll talk about temporary rate buydowns. The most common one is a 2-to-1 rate buydown. So what this means is that the first year of your mortgage, your rate will be 2% less than the full amount for that first year. In the second year, your rate will be 1% less than the full amount for the second year. And then the third year, your rate will go to the full amount. So this is sort of like a ARM or an adjustable rate mortgage, but in this scenario, you have to qualify for the full rate amount before you can even get the mortgage. Now, my favorite way for a buyer to use a rate buydown is to actually purchase a permanent buydown. And so what you can do is you can pay upfront 1% or more, 2% or however many discount points that you want to buy, and each 1% that you buy will get you 0.25% less of a interest rate for the life of the mortgage. Now, with this scenario, this is going to directly impact your mortgage rate for the entire life of the loan, so you only have to qualify for the less amount. If you're buying 1 point, your typical break even on this investment is within about 5 years. So if you plan to stay in this house long term or for more than 5 years, this is usually a great strategy. Now, in my article, I break down a deal in which the buyer uses $10,500 to buy down their rate instead of asking the seller for a $10,000 discount. This saves them $364 per month. Now, in order to get the same impact on their monthly payment, they would have needed to negotiate almost double, almost $25,000 in order for them to save that same amount on their monthly mortgage payment. Now, I recently had a client who's an old school guy who really struggled with the concept of seller paid closing costs because he hasn't bought a house in a long time, and seller paid closing costs are much more popular in today's market than they were, let's say, 25 years ago. And that got me curious when I was doing my study and writing my article. I wanted to know, how often do buyers use seller paid concessions in the average real estate transaction? And the answer is that the national average is almost half of every real estate transaction includes some sort of seller paid contributions. In some metros, they are as high as over 70%, like in Seattle. And I also notice in some metros, they're almost non-existent, like in Manhattan, New York. They are less than 5% of real estate transactions include seller contributions. On the home building side, home builders offer either rate buydowns or direct seller paid concessions in 2 out of 3 real estate transactions. So here's a list of ways that you can absolutely kill a deal using seller contributions. The first one is not understanding what the loan limits are and asking for more than you can actually get based on your loan product. The second one is by inflating the sales price by too much. Now, in a really competitive buyer's market, a lot of the time, in lieu of the buyer asking the seller to reduce the concessions from the asking price, they'll actually inflate the sales price to then include the seller paid concessions. And if you do that by too much, you could blow your deal up as well. The next one is by adding concessions too late in the deal. If you try adding concessions in the 11th hour, this might result in major headwinds for underwriting or actually getting your loan closed. Then there's vague contract language. Always make sure that you ask for up to a certain amount. You always have to ask for a certain percentage or an exact dollar amount in seller paid closing costs. So always make sure that in the contract it says up to. That way you can utilize every dollar that you get the seller to agree to contribute towards your closing costs. Lastly, anytime that you're asking the seller to do anything under the table or any kind of side deals, you're always putting yourself at major risk. In my studies, I also studied the psychological effect of seller paid concessions. I learned about something called the anchoring effect, where sellers become very cognitive of their list price and they just want to stay firm on that list price. But in a lot of cases, they're actually pliable about giving concessions as long as they don't have to come off of that line in the sand that they drew as it relates to their listing price. Because a lot of time framings matter. Sometimes a $12,000 credit feels like a solution where a $12,000 price reduction feels like a negotiation loss. So what are some smart strategies or ways that you can use seller paid concessions or seller paid credits? First thing that I would do if I was a buyer is I would ask my lender, what are the maximum amount of credits that I can ask for and how much do they expect for my closing costs or my cash to close to be? Also, always use up to language in your purchase agreement to make sure that you're not leaving any of those seller paid credits on the table. And if it was me and I had enough money to be able to close my deal and pay for my own closing costs, I would always use seller paid credits to buy a permanent rate buy down on my mortgage rate. Then the last thing, if you're a buyer, is talk to your CPA or your tax accountant and ask them if there are any ways that you can use those seller paid credits as a tax reduction. If you're a seller, always make sure that you're looking at the net sales price rather than the gross sales price. This is going to be up to your agent to help you understand what the net sales price is rather than the gross sales price. If you receive an offer that includes seller paid concessions and you're on the fence about it, always go through a mock scenario of if you end up incurring holding costs for, let's say, 30 days, then 60 days, and 90 days to see if giving the concessions is more beneficial than the potential of flapping in the wind and staying on market and losing those same costs of holding. And just like in the scenario that I spelled out before, consider if your house, let's say, is not selling, instead of a price reduction, offer to pay a rate buy down for the buyers. Because remember, that same $10,500 rate buy down amount, save that buyer $364 a month. In order for them to have that same impact, you would have had to lower your price by $25,000 so you can really leverage less money to increase your own net proceeds at the end. And then lastly, concessions actually protect the market in your neighborhood because the house is going to sell for the gross sales price, which is how it's going to appear to appraisers and other buyers, which keeps comp prices high and keeps values good in your neighborhood. The bottom line is that concessions aren't a bad thing. They're just a tool. It's a lever that you can pull that can make a real estate transaction happen when it otherwise probably couldn't happen. The key is to understand them and all of the concepts and principles and ways that you can use them to your advantage to keep your real estate deal together. I've linked in the description my article on my website that gives a full comprehensive breakdown of all of these different concepts and ways that you can use them. So that's all I have for you on seller paid credits. If you like this video, please give it a like and a share. And as always, thanks for watching.